Meeting of the NCUA Board to order. In addition to those joining us in the boardroom today, today's meeting is open to the public through a live webcast. For anyone watching online, if you would like to view the closed captioning of this meeting, please click on the CC icon located in the lower left-hand corner of the WebEx window. You may also change the layout to one of your choosing by clicking the layout option on the top right side of your screen. The first item of business on our agenda today is a cybersecurity update board briefing. Ernie Chambers, Director, Critical Infrastructure Division, Office of Examination and Insurance, will present. Staff available for questions includes both Ernie and Kelly Lay, Director of the Office of Examination and Insurance. Good morning, Ernie. Good morning, Kelly. Always great to see you. Ernie, please begin whenever you are ready.
Good morning, Mr. Chairman.
Good morning.
Vice Chairman Hoffman, and board member
Good
Wood.
morning.
It is my pleasure to meet with you once more to present the semi-annual cyber briefing April edition. As we gather for the briefing, we are reminded of the continued and evolving cybersecurity threats that face the credit union industry and the financial services sector as a whole. Next slide, please. In this presentation, we will update the cybersecurity threat landscape, emphasizing the continuing need for credit unions to maintain both vigilance and good cyber hygiene in light of some key threats, including ransomware and extortion operations, social engineering, phishing, and open artificial intelligence or open AI platforms, external-facing application vulnerabilities, misconfigurations in cloud environments, DDoS or distributed denial of service attacks, and geopolitical issues. Next slide, please. Additionally, we will provide the latest on the NCUA Information Security Examination Program, better known as ICE, White House National Cybersecurity Strategy, our partnership and engagement activities, and finally, to foot stomp the NCUA Cybersecurity Resources webpage. Cybersecurity risks continue to pose significant challenges to credit unions and the financial sector and require constant vigilance to ensure and maintain the stability of the financial system, protect critical infrastructure, and the delivery of essential financial services. To that end, let's turn now to ransomware. Next slide, please. Ransomware attacks have caused significant financial losses and disruptions for organizations and financial services in recent years. However, there are indications that such attacks had slowed down in 2022, where cybercriminals earned less money from ransomware attacks than they did in 2021. Now, this was due to several factors, including increased law enforcement and government actions such as sanctions and advisories and prioritization of ransomware investigations leading to law enforcement takedowns. Although the revenue from ransomware attacks had decreased, extortion operations threatening to publicly expose stolen data instead of holding the data for ransom likely will become more prevalent in 2023. Extortion is less risky than deploying ransomware as it requires only stealing the data. Organizations must take measures to protect their systems and data from both attacks by segmenting networks, implementing tighter access controls, and for ransomware, maintaining off-site backups. The cost of ransomware intrusion depends on various factors, including the organization's size, security posture, and policies facilitating recovery from destructive incidents. All in all, ransomware attacks may have slowed down in 2022, but the threat of ransomware and extortion attacks will remain a significant concern for organizations and financial services in the coming years. Organizations must remain vigilant and take appropriate precautions to prevent and mitigate the impact of such attacks. Next slide, please. Financial services and credit unions face significant threats from phishing and social engineering attacks due to the sensitive information they hold. Threat actors use tactics such as spear phishing, false job offers, and fake banking websites to exploit human vulnerabilities and bypass security controls. Worse yet, cybercriminals are researching how to leverage AI platforms like OpenAI to generate malicious content, creating personalized phishing emails, and improving malware. To mitigate social engineering risk, organizations can educate their employees, implement policies governing information sharing online, and employ multi-factor authentication. Additionally, AI is expected to play an increasingly significant role in cybersecurity, with the market for AI cybersecurity products expected to reach close to 139 billion by some estimates of 2030. Next slide, please. Credit unions and financial services are highly susceptible to externally facing IT application vulnerabilities, which cybercriminals can exploit to gain unauthorized access to sensitive information or to launch malware attacks. Online banking portals, mobile banking apps, and payment systems are especially vulnerable to such attacks, making it essential for organizations to implement robust security measures. Common vulnerabilities that pose a threat to externally facing IT systems include injection vulnerabilities, cross-site scripting, cross-site request forgery, and broken authentication and session management. To mitigate these risks, credit unions must regularly conduct vulnerability assessments and penetration testing, implement multi-factor authentication, keep software and applications up to date with security updates, enforce a strong password policy, and provide cybersecurity awareness training to employees and customers. Next slide, please. Misconfigurations in cloud computing environments can have a detrimental impact on credit unions and financial institutions, leading to security and compliance issues. Misconfigurations can cause data breaches, theft, exploitation, and non-compliance with industry regulations and standards, resulting in severe fines and legal consequences. To mitigate these risks, credit unions should ensure they have proper training and expertise to configure their cloud infrastructure securely, regularly audit and monitor the cloud infrastructure for vulnerabilities and misconfigurations, implement proper access controls, and follow security best practices. Several high-profile examples, including data breaches of a large bank, a financial data company, and a rideshare company, have demonstrated the significant impact of misconfigurations in cloud computing environments. These examples underscore the importance of prioritizing cloud security and implementing best practices for cloud configurations to mitigate these vulnerabilities. Overall, credit unions and financial institutions must prioritize cloud security and implement best practices to mitigate the risk of misconfigurations in the cloud and protect their customers' sensitive information. Specifically, organizations should ensure data is not publicly accessible, implement proper access control measures, regularly monitor cloud environments for vulnerability and misconfigurations, and finally, educate employees on cloud security best practices to reduce the risk of data breaches. Next slide, please. DDoS, or distributed denial of service attacks, pose a lingering and very real threat to credit unions and financial institutions due to the sensitive nature of their business and the large amounts of financial transactions they handle. Carried out by botnets, which are large networks of compromised computers controlled remotely by attackers, distributed denial of service attacks involve overwhelming a website or network with traffic, making it inaccessible to legitimate users. Attackers may also use DDoS attacks as a smokescreen for other cyber attacks, such as stealing data or installing malware. DDoS for hire services, also known as booter and stressor services, are illegal online services that offer distributed denial of service attacks as a service to customers for a fee. Cybercriminals commonly use these services to launch distributed denial of service attacks against credit unions and other financial institutions to disrupt their services, steal customer data, or hold them for ransom. To mitigate risk of DDoS attacks, credit unions and financial institutions should take proactive measures to monitor their networks for suspicious traffic, block traffic from known malicious IP addresses, and implement redundancy and failover mechanisms for critical systems and services. By prioritizing network security measures and following best practices for mitigating DDoS attacks, credit unions and financial institutions can reduce the impact of these attacks and protect their customers' sensitive information. Next slide, please. Geopolitical risks continue to threaten, with Russia identified as the top risk. A cornered and humiliated Russia could become the most dangerous rogue state and pose a significant threat to Europe, the U.S., and beyond. Kremlin-affiliated hackers are predicted to ramp up increasingly sophisticated cyber attacks on Western firms, governments, and infrastructure. Furthermore, Russia is expected to intensify its offensive against the West by supporting disinformation and extremism. Other risks, such as inflation shockwaves and malicious actions by Iran, each portend to exacerbate geopolitical and economic impacts, as do recent advances in artificial intelligence, which may further complicate systemic challenges. Continued investment in cybersecurity is essential to mitigate these risks and protect our global community. Next slide, please. Turning to ICE. The National Credit Union Administration has implemented the Information Security Examination, or ICE program, to improve the efficiency and effectiveness of its IT examination procedures and its overall safety and soundness mandate. The ICE provides a structured workflow for examiners to identify and address regulatory, cybersecurity, and information security risks for all federal credit union and FISCU examinations. The ICE program focuses on NCUA regulation, draws guidance from various sources, and has three types of exam-level statements: Small Credit Union Examination Program, or SKU-UPS, or SCUP statements, core statements, and core plus statements. The ICE program enables examiners to tailor the examination based on asset size and complexity, standardizes the examination of a credit union's information security and cybersecurity program, and enhances the identification of control deficiencies and trends at the industry level. The key benefits of the ICE program include a repeatable and consistent process for conducting the examination, succinct statements that improve clarity and expectations, inclusion of regulatory citations, supplemental guidance, and best practice resources that facilitate examiner access to relevant knowledge and resources, as well as a process to collect results from every ICE examination, enhancing the ability to identify control deficiencies and trends at the industry level. The NCUA will continue to provide credit unions with cybersecurity resources and update its examination procedures as necessary. Next slide, please. The Biden administration's cybersecurity strategy, or the National Cybersecurity Strategy, outlined has important implications for the financial services industry and credit unions. The strategy's focus on public-private partnerships, protecting critical infrastructure, and building international cyber alliances is particularly relevant to the financial services sector, which is crucial to the nation's economy and society. Regulation is also a key theme of the strategy, which could help spur investment and innovation in cybersecurity technologies and practices. The strategy's emphasis on increasing investment in cybersecurity education and training programs is also significant in addressing the cybersecurity workforce shortage faced by many financial institutions. As financial institutions operate on a global scale, the strategy's focus on building international cyber alliances to address global cyber threat is relevant. Protecting critical infrastructure is another central theme, and the financial services industry is a critical component of the nation's infrastructure. Overall, the administration's cybersecurity strategy represents a shift in government's approach to cybersecurity, emphasizing collaboration, regulation, and innovation. Next slide, please. The NCUA continues partnering with industry and interagency organizations to raise awareness of cybersecurity risks to credit unions, supporting outreach events, providing training, providing assessment tools and other resources on NCUA's Cybersecurity Resources webpage, and publishing cyber alerts and notifications to credit unions via its GovDelivery resource tool. The agency is also publishing cyber information notices and notifications to subscribers to keep them informed. Next slide, please. On a final note, we just want to foot stomp and to have folks remember to visit the NCUA Cybersecurity Resources webpage at ncua.gov/cybersecurity, where many useful resources and reporting in the area of cyber information security can be found. In summary, credit unions continue to face many cybersecurity challenges, including the risk posed by externally facing IT application vulnerabilities, misconfigurations in cloud computing environments, and DDoS attacks. That said, it is of the utmost importance that credit unions implement cybersecurity best practices such as regular vulnerability assessments and penetration testing, as well as employee education and training to mitigate these risks. Sir, that concludes my remarks, and we're ready for your questions.
Thank you, Ernie, for that informative briefing on cybersecurity issues confronting the National Credit Union Administration and its stakeholders. And Kelly, as always, welcome to the table. I often say that cybersecurity keeps me up at night. These semi-annual briefings are a reminder that the potential for cyber attacks in the financial services industry and the credit union system are high and will likely stay that way for the foreseeable future. Therefore, all of us must improve our cybersecurity hygiene and practices. With that in mind, I'd like to start earning my questions at the high level. I know that you briefly covered the White House and its new national cybersecurity strategy on slide 11. I'm wondering if you could go a little deeper and tell what the implications are of that strategy for credit unions in particular and the broader financial services system.
So I'll actually take that question
there you go.
for today. So as Ernie mentioned, the White House National Cybersecurity Strategy is focused on public and private partnerships and those international cyber alliances. And so we think that's particularly relevant to the financial services sector. One of the things he mentioned was collaboration, innovation. I think that can only serve to help the credit union industry. We also believe that emphasis in increasing investment in cybersecurity education and training programs would also be significant in addressing what we see today as like a cybersecurity workforce shortage that might be faced by many financial institutions as well.
That is perfectly understandable, and that shortage is especially acute at smaller credit unions, which often lack a dedicated IT professional focusing on them. Second, I'd like to get an assessment as to whether ransomware attacks at credit unions continue to be a concern. I heard you saying that the overall numbers have fallen year over year in terms of total ransoms collected, but are credit unions of any size potentially vulnerable to ransomware still? And what might the costs be for a credit union, say of $1 billion if they were attacked by ransomware?
Sure, yes, sir. Thank you for that question. Ransomware attacks remain a significant concern for credit unions and the financial services sector as a whole, because these types of malware attacks encrypt organizational files and demand payment in exchange for the decryption key to unlock those files. The cost to credit unions and other financial ecosystem entities is often measured in significant disruption to operations as well as financial loss. Credit unions and financial institutions of all sizes are potentially at risk for ransomware attacks, as these attacks can be carried out by sophisticated criminal organizations or lone attackers. Our cyber criminals may target smaller credit unions that may have less robust security systems in place, or they may target larger institutions for a potentially higher payout. The cost of ransomware attack can be significant for credit unions, both in terms of financial losses and damage to reputation. The cost of the ransomware itself, sir, can be significant, with some attackers demanding millions of dollars. Additionally, credit unions may incur costs associated with restoring systems and data, conducting investigations, and implementing new security measures to prevent future attacks. So there are also many other intangible costs, such as the loss of customer trust and the damage to the credit union's brand.
So my big takeaway there is, for $1 billion institution, $1 million plus ransomware attack would not be unheard of.
Not at all, sir.
And in fact, you could see smaller credit unions having ransomware costs of that size.
Exactly,
So
in the hundreds of
that's a
thousands.
really good reminder to all of us to stay vigilant. Adopting new technology is also essential for credit unions to remain competitive. However, the credit union system cannot and must not be the soft underbelly that endangers the broader financial system and our economy. Each of us, the NCUA, state supervisory authorities, credit unions, and their vendors, has a responsibility to protect our systems, improve our ability to recover from incidents, educate our teams, share information, and report and address potential vulnerabilities. For our part, the NCUA team is working to deploy the new information security exam system, and we recently approved the cybersecurity incident notification rule, which goes into effect in September. What concerns me more are the countless threats we don't know about. The unknown unknowns, as Donald Rumsfeld once said. And these risks are likely to continue to accelerate, especially as more credit union operations migrate to third-party providers and credit union service organizations. Unfortunately, QSOs and third-party service providers do not have the same oversight level as those vendors of banks. This growing regulatory blind spot in the financial system exacerbates this vulnerability of exploitation by bad actors who threaten our nation's economic security and the financial well-being of our citizens. On the issue of QSOs and third-party vendors, I've got a few questions for both of you. First, as someone with both of you with a deeper understanding of the cyber risks facing our nation's critical infrastructure, of which the financial system, of which credit unions are part of that system, what are the risks associated with the NCUA's inability to examine third-party vendors, and what do they do that keep you awake at night?
Wow, sir. Well, thank you for that question, Mr. Chairman. There's certainly a plurality of risk in the cyber domain that keep me up at night. The first, so many of our regulated entities are not in a position to have someone on staff to manage information technology with a dedicated cybersecurity operations center, like many organizations do. For this reason, they contract these types of services out, and there exists a great deal of reporting confirming that indeed there have been in the past, and there remain, foreign intelligence service connected operatives who masquerade under a guise of legitimacy, U.S. owned and operated, and that service the financial industry, but who in fact provide those managed cybersecurity services from locations outside of the United States and often with malicious intent. Case in point, we can go back to 2017, the Kaspersky issue with the binding operational directive, which serves as a cautionary tale for the potential risk posed by foreign entities in the U.S. financial system, and they were actually operating on U.S. soil. In October 2020, the U.S. Department of Treasury's Office of Foreign Assets Control, or OFAC, issued a warning to U.S. businesses about the risk of doing business with foreign entities that are connected to foreign intelligence services. The warning specifically targeted entities that masquerade as providing services to U.S.-based banks and other financial service entities. The warning noted that those foreign entities may be using their access to U.S. financial institutions to engage in illicit activities such as money laundering, sanctions evasion, and cyber attacks, an issue with supply chain and third-party implications. The OFAC warning underscores the importance of due diligence and risk assessment when conducting business with foreign entities and highlights the potential risk posed by foreign entities to the safety and soundness of U.S. credit unions. And then most recent, we know of what's happening or has been identified in New York in open source reporting relative to the Chinese influence. The U.S. has expressed concerns over obfuscated influence operations by the Chinese government that target U.S.-based firms doing business in and with China. The U.S. government believes that the Chinese government is using these operations to gain access to sensitive information and intellectual property across critical infrastructure sectors. Overall, sir, these three examples highlight the risk posed by foreign entities to the safety and soundness of U.S. credit unions and hence are exemplars, reflecting the need for the NCUA to have vendor review authority to enable it to address such risk as these. Leadership requires seeing strategically over the horizon for those emergent threats, risks, and vulnerabilities. Without said authority, NCUA, sir, frankly, is operating, if not in the blind, certainly with only one eye open. And as a former fighter, I can tell you that is not a winning strategy.
No, it's not. It's not. Thank you for your candor, Ernie. And you said something earlier about smaller credit unions. If I just can dive in, if the NCUA had vendor authority, would it be a measure of some regulatory relief for those smaller institutions, because we could help them by not only going in and doing the reviews on the vendors, but then we would share the reports with them. So, I mean, they would still have to kick the tires for their own due diligence, but that would be, having somebody to assist them, that would be helpful, wouldn't you say?
Yes, sir. I've been a little long-winded this morning, but a very short and succinct answer, yes.
Ernie, you are never long-winded. You are always precise and informative. It is essential that stakeholders understand the risks resulting from the NCUA's lack of vendor authority are real, and they can have significant implications for the health and the stability of individual vendors and credit unions, as well as the credit union industry and the broader financial system. Why is visibility into the operations of service providers so important? What can we gain after the fact if one of these vendors, or a credit union for that matter, has already been hacked?
Sure.
I'll take that question, Chairman. So one of the reasons that the board just approved the recent cyber notification rule was for information sharing. And I think that we need that vendor authority so we can not only participate in information sharing sessions with other banking regulators, but also if we see something of concern, we won't be operating in a silo. We would be able to provide critical information to other U.S. government agencies that work to protect other areas of our nation's critical infrastructure, like power and water supply, healthcare, industrial control systems. Credit unions and banks are not the only targets of our foes around the world, and the cyber tools and tactics we might learn about in that financial space could also be deployed against other critical infrastructure sectors and vice versa. Being able to communicate with agencies like FBI, the Department of Homeland Security, the National Security Agency, and others about the things that we're seeing and the things that they're seeing really would help keep our nation secure from all angles.
Brilliant. Thank you, Kelly. Until this growing regulatory blind spot is closed, thousands of credit unions, tens of millions of consumers who use credit unions, and roughly $2 trillion in assets are exposed to potentially devastating risks. The Government Accountability Office, the Financial Stability Oversight Council, the NCUA's Inspector General have all recommended congressional action to provide the NCUA with this examination authority. I fully agree with these experts. Restoring the NCUA's authority over CUSOs and third-party vendors will bolster our nation's economic security. It will also give credit union members the same protection that bank customers enjoy. The NCUA will continue to engage with Congress on this important issue. That concludes my remarks and questions. I now recognize the Vice Chairman.
Thank you, Mr. Chairman. Ernie, I agree with the Chairman. You're fairly concise, not long-winded. You might want to consider joining the board. But I'm also going to do what the Chairman did, which is try to intersperse questions within my prepared statement, okay? So I would say thank you, Ernie, for the presentation, and Kelly for being here for questions. We obviously can't overstate the significance of cybersecurity. Highly sensitive info and systems are of great value to bad actors. It's gratifying to hear that bad actors earn less money with ransomware last year. That said, we shouldn't be surprised that the problem reappeared in a different form with extortion operations becoming more common. The game whack-a-mole comes to mind. We stopped there, and cyber seems like it's always going to be with us in some way, right? I've said before, you have tremendous job security.
Thank you, sir.
Anybody's good at cyber. There's not a lot of unemployed cyber experts, right?
Sure.
I'm wondering if you think larger picture that it seems as long as we use computers and systems, there's going to be issues, but are there ways that we can move, like the way ransomware went down? Can you first start and say, why do you think there was a reduction last year? Why did criminals get less money in ransomware? They obviously like having more money. Why did they get less?
Absolutely, sir. Well, it's the there's a theory in law enforcement around broken windows.
Yep.
So those that are vigilant can, of course, there's a what's the word I'm looking for? A shifting. If I can't break into your house, I'll go to the next guy. So the financial services industry overall is quite robust in its in our protection and our vigilance. So I would say, coupled with law enforcement activities against such bad actors, would be the key driver.
What I'm wondering is, and this is hard to predict, right? But some crimes go away and are reduced because of a variety of factors. When you and I were younger, people used to get mugged a lot on the street. Stick up, give me your wallet, right? That is way, way down from when I was younger. And the primary reason is people don't carry cash as much. Humans haven't changed. The cost benefit did.
Yes, sir.
It's still felony armed robbery, but if you rob an average millennial, you'll get $1.50 and like an expired MetroCard, right? And you see it with sticking up stores and restaurants, same thing. Some chains like the, Sweet Green, salad chain, they went to no cash at all. They don't accept it.
Exactly.
You can walk in there with $1,000 in cash, you cannot buy. So, and I remember this because it was kind of controversial. Sweet Green said they did it for safety, so that people know that they're less likely to get held up, right? Because they don't have any cash in the register. It was controversial because some people thought the Sweet Green was like trying to screen out low-income people. Personally, I think it's really the $14 salads that screen out the low-income people. But can you see that happening in this sense, where it just becomes less, where the money isn't there, you get caught more? For example, people used to do ransom with Bitcoin and early on, and then people realized the whole point of Bitcoin. It's a public blockchain with an immutable ledger, forever, unalterable by anyone on earth, of exactly when and where and how much and to whom the money went to. And you realize that's actually a really terrible way to get ransomware. Can you see a scenario, I know it's kind of a broad question, but like the mugging, right, where society changed and we're not in danger of being held up as much just because of other reasons. We don't carry cash anymore. Can you see that happening?
Absolutely, sir. I think the answer is within your context. Why do folks rob banks, or why did they?
Yeah.
Bank robberies are significantly down. Armed bank robberies, because although the money's there, it's a little bit harder to get to.
Cost benefit change. Humans didn't. Right.
Cost benefit change. So yes, I could see that, and I'm hopeful that that will evolve. We've got digital citizens now. Kids like my kid were born with these iPads in their hands. They're gonna, hopefully, not my son, but hopefully there will be others like him, or there will be others like him that I'm sure will use those tools and platforms to access and get.
I hear you that.
Those
Yeah.
things, yes, sir.
I agree with Todd. Cyber keeps you up at night, but for me, it's cyber and my 2-year-old son that keep me up at night. So, talk about social engineering. I'm defining it here as criminals using personal info to impersonate someone else. That's a major risk. Just the staggering amount of data available on individual social media makes social engineering easier for criminals. And artificial intelligence is helping entities like credit unions combat fraud, but it helps the criminals as well. It's remarkable how fast all that's happening. Just as an aside, I was a podcast I went on, Joanne Barefoot. She's a great interviewer. You guys, you've been on it.
We have,
You both have. We've all been on it. I saw her yesterday. You know what her guest is next week? Chat GPT. She's having a discussion with AI. There's no human, so obviously she can schedule it whenever she wants, right? And it's in depth on financial policy. So I can't wait to hear it. And she's picked a voice that sounds like a human voice, It's not like a Siri where it sounds like someone just had like helium, Anyway, that's her guest next week. Interesting. Is speaking to a computer in depth on financial policy in a normal voice and a normal cadence and everything. It's remarkable. And this is only in the last few months, right? It's remarkable.
Yes, sir.
Somebody can call up someone in my voice with my accent and my cadence with all my info, and the person would never know it. With any luck, the person who answered the phone was also AI, and they did that. But, we use the cloud here at.
May I add for just a
Yeah,
second?
please.
Your cadence is always fast, so
Okay.
that may be easier.
Anyone speaking slowly and it's easy to understand. Now, you're not. No way. Kyle's hard to understand. You're right. Yeah. And by the way, you can measure that with voice to text, like closed captioning. You can actually measure how clearly you speak. I just want to get out, so I'll just do this. I'll want to give a shout out to Kelly's group, Examination and Insurance, deployment of our Information Security Examination Program, ISE. Are we calling it ICE?
Yes, sir.
Okay. For examiners, it's a risk-based approach to tailor exams to the size and complexity of the credit unions. I think we all share a belief that it's important that the juice is worth the squeeze on these small credit unions. Sometimes it's two senior citizens in the basement of a church that are running a church credit union, right? So the juice has to be worth the squeeze. And we always say, no financial institution should be too big to fail, and you shouldn't be too small to succeed either. So I appreciate the tailoring. And one more shout out and a reminder about our automated cybersecurity evaluation toolbox, ASET. This has been useful. I have been complimented on that, by the way, and I accept the comments, even though I had nothing to do with it, you know, but when I'm out talking to people at conventions, it is very useful, and especially for people like me who are not at all experts on cybersecurity. And I'll ask another question. What's the low-hanging fruit here? If you're a credit union, this stuff is scary. You only have a single-digit number of employees. What's the, 20% of work that can get you 80% of there? The low-hanging fruit, good hygiene here.
Yes, sir. That's a great question. And credit unions can take several steps, but I'll give them three key: implementing robust cybersecurity measures such as those regular vulnerability assessments, pen testing maybe above some of the smaller, but employee education and training. I mean, is one of the key elements that can be implemented by almost anyone to make the enterprise raise the level of security. Implementing multi-factor authentication, and then finally backing up critical data. Those three things, and you're safer than not.
Okay, and for those of us that don't understand this, cloud systems, right? Cloud's useful. We wouldn't use it otherwise. It's probably half of Amazon stock prices, the cloud stuff. And we're going to talk about climate in a minute. And I remember, so I was researching it, looked at like Katrina in 2005, right?
Yes, sir.
And one of the issues was massive destruction of records from flooding. Obviously, that's physical records. Now, we talked to Kelly about, should we make sure that people are only keeping as much physical stuff in storage lockers that they have to? But that's a problem we've kind of solved in terms of data destruction. A flood is not going to destroy the stuff in the cloud, right? You might have to wait to get power back on, but it's there. What does misconfiguration risk in cloud systems, what does that mean?
Yes, sir. Misconfigurations in the cloud computing environment can have several risks for credit union systems. Data breaches are leading to data breaches, theft, exploitation, and non-compliance with industry regulations. Essentially, if I could shorten even what I have written here, is to make sure that the due diligence for the contracts and the master service level agreements that are being engaged by credit unions with those managed service providers, as long as there is a level of deep engagement around the do's, do nots, the who's responsible for what, then we can make the environment a lot safer. Yes, sir.
Thanks to you both. Back to the chairman.
Thank you so much, Board Member Hood.
Great. Thank you, Mr. Chairman. And also thank you, Ernest, and also Kelly for today's presentation. I, like my fellow board members, also find that cybersecurity does keep me up at night, but also it's not just me. When I meet with any of the global regulators, they all say that cybersecurity is that one issue that they all fret over. So I'm glad that we are keeping it top of mind here. If there's anything that we can learn and glean insight from today's briefing, is that cybersecurity threats will continue to evolve and that we cannot at all rest on our laurels. That means that credit unions and the NCUA must be prepared at all times. We know that with today's geopolitical tensions, the risk of cyber warfare has grown exponentially. Adding to that concern is that financial technology tools and systems have become more widespread and integrated into the mainstream of financial industry operations. The good news is that while the threats continue to grow and evolve, so does our ability to counter those threats. Additionally, open communication is critical. To that end, the NCUA recently sent several cyber alerts to the industry using a new GOV delivery platform. Can one of you please discuss how credit unions can make sure that they are receiving these timely alerts?
I can take that question, Board Member Hood. So yes, we did send some recent cybersecurity alerts to the credit union system. And Gov Delivery, as you mentioned, is a web-based email subscription system that allows credit unions to subscribe to news and information feeds, but we use it in two ways. So we can push those alerts to the credit union industry. And for example, the cyber alerts is something that we would push to the CEO, the chief information officer, and the IT security contact information that we have. And then credit unions can also subscribe to that service to get various different types of information from the agency, and can sign up at ncua.gov/subscribe.
Great. Well, thank you for that. And I hope the industry is taking note. And also, Whenever I'm speaking to any credit union group, I mention ACID, I mention ICE. I tell you, if there's one group, not that I don't talk about the other groups within the agency, but cybersecurity and all the tools that we're making available to assist the credit unions with cybersecurity and sort of battening down their hatches, I try to do my level best. But you all, unfortunately, cybersecurity isn't one of those areas where we can just set it and forget it. It's an ongoing commitment. That requires constant due diligence as well as keeping up with the latest ways to best harden systems to limit attacks. Due to the nature of the threat, we all need to make cybersecurity a top priority to protect credit unions, their employees, and member owners. Credit unions should expect more regulation in this area. As I often say, regulation should be effective and not excessive, and this, you all, is clearly an area where more effective regulation may likely be needed. While I don't have questions, I just want to make a comment, and that is innovation is also something that's really near and dear to my heart, and we do have our new Office of Innovation and Access here at the agency. Could you talk about how you are working with the Office of Innovation and Access, since innovation and cybersecurity can often go hand in hand?
Sure, I'll take that question. So I very regularly check in with Charles Weiss from the Innovation Office. We speak about different topics. We get questions, related to cybersecurity or questions around fintech and innovation. And it's, the fintech and innovation office, it's E&I, it's our new cybersecurity coordinator. We're all working together to make sure that we are responding to those questions and checking in with each other and to make sure that, what one office is doing, the other offices is very aware of.
Well, that's good to hear, and thank you for that response, because this is an area that really should be adopted and accepted by all areas within the agency and not just siloed. So I'm glad to know that you all are having those cross-functional meetings. Also, I just again remind folks of looking at the NCUA webpage, because a lot of those resources are there. That one slide, that is the most insightful slide for folks to use and closely pay close attention to whatever new developments are taking place. I have no further questions or comments other than thanking you all for today, and I look forward to the next briefing soon. Thank you, Mr. Chairman. That concludes my remarks.
And thank you so much, and may we also be, hopefully, have no incidents between now and that next briefing overall. Thank you, everybody.
Yes, sir.
Thank you.
Thank you.
The second item on our agenda today is a request for information and comment, climate-related financial risk. Staff presenting are Lisa Roberson, Deputy Director, Office of Consumer Financial Protection. I meant to say Roberson, not Roberson. I apologize. Rachel Canoni, Deputy Director, Office of the Chief Economist, and Marvin Shaw, Senior Staff Attorney, Office of General Counsel. Good morning, Lisa, Rachel, and Marvin. Please start whenever you are ready.
Good morning, Chairman
Good
Harper,
morning.
Vice Chairman Hopman, and Board Member Hood.
Good morning.
I'm Rachel Canoni, Deputy Director of the Office of the Chief Economist, and as was already mentioned, with me today is Lisa Roberson, Deputy Director of the Office of Consumer Financial Protection. Lisa and I also serve as co-chairs of NCUA's internal climate-related financial risk working group. Also joining us today is Marvin Shaw, Senior Attorney Advisor and another member of the climate-related financial risk working group. We are here today to request that the NCUA board publish a request for information and comment on climate-related financial risk. Before we delve into the details of the RFI, let me provide some context. Climate change and measures taken to address climate change, both now and in the future, may pose risks for the broader economy and financial system. These risks can be grouped into two broad categories: physical risk and transition risk. Physical risk refers to harm to people and property caused by discrete climate-related events like hurricanes, wildfires, and heat waves, as well as longer-term chronic phenomena, including changes in precipitation patterns, sea level rise, and higher average temperatures. Transition risk refers to stress on institutions or sectors caused by measures taken to move towards a less carbon-intensive economy. So this transition will involve responding to public policy changes, adopting new technologies, and adapting to shifts in consumer and investor preferences, which may lead to higher costs and substantial shifts in asset values. If these changes occur in a disorderly fashion, the effect on individuals, businesses, communities, and financial institutions could be sudden and disruptive. Climate-related physical and transition risks tend to manifest as traditional financial risks, including credit risk, liquidity risk, market risk, and operational risk. For example, disruptions in economic activity caused by climate-related weather events like flooding or wildfires may affect household income and the ability to stay current on household financial obligations. The property damage associated with such events could affect the value of the homes and mortgages collateralized by household-owned real estate. The collateral value of motor vehicles may also be affected as consumer preferences shift away from gasoline-powered vehicles to electric and hybrid vehicles. Finally, a credit union's field of membership is often tied to a specific industry, such as oil refining or agriculture. The movement to renewable energy and changing weather patterns will affect many of these industries in the future. Economically vulnerable communities are particularly threatened by the physical effects of climate change. Climate-related disasters can cause property damage and can also lead to job losses and undermine economic output, reducing already limited household income and wealth and diminishing access to capital. Additionally, changes in government policy or guidelines due to climate change may increase the cost of homeownership in vulnerable communities. Financially vulnerable households and communities are the least able to absorb the costs associated with climate-related disasters. These areas may have more difficulty adapting as society transitions to a less carbon-intensive economy. Climate-related financial risks may be amplified for federally insured credit unions serving these communities. But climate change and efforts to address climate change may also present new opportunities for credit unions. For example, efforts to move to a carbon-neutral economy could generate demand for renewable loan products and services, such as loans for solar power generation, biodiesel development, residential or commercial energy efficiency upgrades, and solar panel installation. For the past 18 months, a small team consisting of representatives from offices across the NCUA has been studying climate-related financial risks to credit unions. This work has occurred alongside an effort by FSOC member agencies, including the NCUA, to build institutional capacity to measure and respond to climate-related financial risks. Our aim in publishing this request for information is to improve the NCUA's understanding of climate-related financial risks, how credit unions view those risks, and how the agency can best support the industry in mitigating those risks. In addition, we're hoping to gather information on the products and services credit unions may be offering to leverage the opportunities presented by transitions to clean energy. The RFI does not speak to the permissibility or impermissibility of any specific activity. It does not imply any intention to modify existing requirements applicable to federally insured credit unions, and does not grant federally insured credit unions any new authorities or limit any existing authorities. And now Lisa will provide some background information on how we developed the RFI, the types of questions we ask, and how we plan to use the information we collect. Lisa.
Thank you, Rachel. Good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. Several federal financial regulators, including the CFTC, the OCC, the FDIC, along with the FHFA, have issued requests for information to improve their understanding and oversight of climate-related financial risks as they relate to the institutions that they supervise. We looked to those RFIs as we developed one specific to the credit union industry. Representatives from several offices across the agency contributed to the development of the RFI, including staff from the Office of Consumer Financial Protection, the Office of the Chief Economist, the Office of General Counsel, the Office of National Examinations and Supervision, the Office of Examination and Insurance, the Office of Credit Union Resources and Expansion, the Office of External Affairs and Communications, and all 3 regions. The request for information includes 38 questions for the public's consideration. The questions posed solicit input on a variety of topics, including current and prospective climate-related financial risks to federally insured credit unions, related entities, and the National Credit Union Share Insurance Fund. The RFI also seeks input on the extent to which NCUA should develop guidance, regulations, reporting requirements, and supervisory approaches to federally insured credit unions' management of climate-related financial risks. The questions are categorized as follows. The first set of questions asks about climate-related physical risks that are or may in the future affect the industry and measures that can be taken to minimize those risks. The second set of questions covers climate-related transition risks that are or may in the future affect the industry and measures that can be taken to minimize those risks. The RFI also poses questions about potential adjustments to operation, governance, business strategies to account for climate-related financial risks. In addition, there is a set of questions about risk management, including methods and metrics for identifying and measuring climate-related financial risks and associated challenges. Another set of questions asks about climate-related opportunities, including the support needed to expand products and services and any barriers that credit unions may face. Several questions solicit suggestions for the NCUA, and the final set of questions covers data and measurement. In addition to answering specific questions, the public is also encouraged to provide any other information that might be relevant for consideration. Public comments received in response to the RFI will help the NCUA identify and assess current and future risks to federally insured credit unions and the National Credit Union Share Insurance Fund. This information will also enhance the NCUA's understanding of climate-related financial risks within the credit union system and tools to manage those risks. Finally, we'd like to emphasize that the information collected will not be used in the examination and supervision of individual credit unions. Any new requirements for credit unions associated with climate-related financial risk that would require changes to our regulations or to examination and supervision procedures would be subject to board action and approval before implementing. This concludes our remarks. We would be happy to answer any questions that you have.
Thank you so much, Rachel and Lisa, for your presentation, as well as Marvin for being here today to answer questions. And thank you all for your leadership on the Climate-Related Financial Risk Working Group. Additionally, I want to thank all of the other team members from across the NCUA's program offices for the contributions in bringing this request for information before the NCUA board for consideration today. This Saturday is also Earth Day, an annual event highlighting the importance of protecting the environment. So there is no better time than now for the NCUA board to act on this important matter. As a regulator and insurer, the NCUA has a duty to ensure that the institutions it oversees remain resilient against all material risks. Those risks include climate-related financial risks. This request for information is essential to furthering our understanding of these issues and their implications for the overall resiliency of individual credit unions, the vibrancy of the credit union system, and the strength of the National Credit Union Share Insurance Fund itself. Climate change continues to accelerate, and the costs of climate-related natural disasters are rising, often hitting disadvantaged communities the hardest. According to the National Oceanic and Atmospheric Administration, the United States experienced 20 separate billion-dollar weather and climate-related disasters across the United States in 2021, causing more than $156 billion in damage. In 2022, there were an estimated $15 billion plus disaster events, costing in excess of $171 billion, or $16 billion more than the year before, making it the 8th straight year with 10 or more billion-dollar plus events. And an analysis by the research nonprofit Climate Central found that between 2017 and 2021, the nation experienced a billion-dollar plus disaster every 18 days on average, compared to 82 days on average between such events in the 1980s. Moreover, in an NCUA research note released yesterday by our Office of the Chief Economist, that report found that roughly 1 in 4 of all federally insured credit unions are located in communities classified as having a relatively high or very high risks of experiencing the negative effects due to natural hazards. Specifically, the research showed that 25% of credit unions located in communities with a high or very high risk of experiencing adverse outcomes from natural hazards accounted for 34% of the system's wide assets. So it's a disproportionate number there. And that's about $750 billion total that are based in these areas. The report also found that minority depository institutions face a substantially higher risk than the credit union system as a whole. And this is notable, credit unions most at risk of negative outcomes due to natural hazards tend to be located in coastal areas, particularly in California, Texas, and Florida. These 3 states account for 11% of credit unions located in communities with elevated risk and 22% of the credit union assets. Floods, droughts, wildfires, blizzards, hurricanes, tornadoes, and other climate-related events damage or destroy homes, farms, small businesses, vehicles, and vital infrastructure like roads, bridges, levees, and sewer systems that are connecting these homes, these farms, and small businesses to each other. This damage has a cost, including to federally insured credit unions that finance such house purchases and member small business projects. With this request for information, the NCUA is interested in better understanding stakeholders' views and experiences on climate-related financial risk. Commenters are encouraged to discuss any relevant issues they believe the NCUA board should consider about the financial risks associated with climate. This includes, but is not limited to, risks posed or stemming from issues around fields of membership, lending, investments, other assets, deposits, underwriting standards, insurance coverage, liquidity, and capital. Anyone who's a stakeholder, those within the credit union system and interested parties outside of it, is encouraged to provide the NCUA with comments. It's important that the NCUA understand any potential risks extreme weather events may have on the credit union system and individual credit union balance sheets. The answers we receive may allow us to discern what tools credit unions would like to have to assist them in effectively monitoring, managing, and mitigating climate-related risks, financial risks. And I really do want to ask staff, as you're going through, we've developed some marvelous tools. You talked about it earlier, the ASET tool. Which
Cecil, too.
I was going to say, I was about to go to Cecil, simplified Cecil spreadsheet. Our job, if we can help give credit unions, particularly small credit unions, the tools they need to manage these, we will move the ball a long way in the credit union system. So I do ask that you keep an open mind and look for those opportunities as you're reviewing those comments. Finally, it's worth noting that the NCUA's request for information is for informational purposes only. Responses to this request for information will not be used as part of the current NCUA examination and supervision program. Moreover, I want to assure both of my fellow board members, and I know that I would fully agree with them, if there were a subsequent change in agency policy and supervision related to climate-related financial risk, that change would be agreed upon by the entire board, similar to any other policy change we would make. That concludes my remarks. I now recognize the Vice Chairman.
Thank you, Mr. Chairman. Thank you, Lisa, Rachel, for the presentation, and Mr. Bragg. And to NCUA's internal climate group, who've worked for a while on the RFI. I also want to thank our representatives in the broader working group convened by FSOC, Financial Stability Oversight Council. I know it's a lot of effort to put the RFI together, deciding on the 38 questions. I understand why Chairman Harper convened that working group of climate financial risk. I understand why an insurer like NCUA would examine this very important topic. Natural disasters and massive damage associated with them happens every year. I grew up in two places. Both of them are islands in the Atlantic Ocean. The reason I lived in those two places is my dad's 30 years in the National Park Service. One was a national park, one was a national seashore. We've talked about Fire Island. In his efforts to preserve the national seashore in particular, which got pummeled routinely by hurricanes northeast, physically changed the shape of the island, to do his job of preserving the national seashore for the American public, to protect the natural environment, and to reduce the loss of damage to property and loss of life. One of his biggest obstacles to do those things were government policies, including federal government policies. I'll get to that in a second. So I also know that today's vote is technically just about NCUA publishing a request for information. RFIs are a good faith effort to gather information and may or may not even result in any concrete actions. In fact, other agencies have put out similar RFIs that as of now have not resulted in any action. So I get it. This RFI may not result in any action at all, much less anything harmful. I can even think of some narrowly targeted positive results, such as the one you mentioned, sir, the new business of charging stations at gas stations. I guess they're quite expensive, right? You said $4,000.
They can range up to about $8,000.
Yeah. So the gas station obviously wants to get all the cars stopping there and buying overpriced Doritos and stuff in the store. So the charging stations, they're expensive. So there's a new business that didn't exist. You might need a loan for an EV charging station. That did not exist. And places like California may be more common. And I know if I was an examiner, I would be more comfortable if I understood the new terminology and new financial products and new business lines. And I'd also be more comfortable knowing that other examiners are dealing with the same thing at other credit unions. We had a situation where one of my pet interests, blockchain technology, digital assets. State Charter Credit Union raised some eyebrows with some of the things they were doing. Our people went there. The state regulator was in the room, learned about what the CEO is doing, and I personally, she's very on top of it, in my opinion. And they said, whoa, okay, not only is this not a concern, this is very interesting stuff. You're doing things that are faster, better, cheaper, more secure. But CEO, can you help us train other people? Because there are probably other credit unions, who are not as forward-looking as her. This is going to come up, right? I get it 100%. I just want to be very clear about that. I'm here to state the RFI might wind up being beneficial for all parties, credit unions, us. Essentially, I think there's some ways this can go well, but also quite a few ways this can unintentionally wind up doing harm to both the Share Insurance Fund and credit union members. I'm referring to the broader effort, not necessarily the RFI itself. I'm going to vote no for the following reasons. One, those closest to these natural disasters and changing markets are best positioned to understand and manage those risks. We in the DC area don't need to tell folks in Puerto Rico that they get hurricanes. We've already had situations where, let's say, a credit union, in Puerto Rico, for example, credit union is deciding on a loan to a member affected by a natural disaster. And the credit union employees themselves, CEO and lending officer, lost their homes in the natural disaster. And the office they're meeting in, the credit union office, was also rendered uninhabitable for a period of time. I feel that the people in that room have a better understanding than those of us in this room. Two, I have four, by the way, the history of unintended consequences of government interference in private markets. It so happens, there's an easy example here, National Flood Insurance Program. It's a useful comparison because NFIP is the one government program which solely exists to manage risks associated with severe weather events. You worked on the Hill. NFIP has become a political football with bipartisan agreement that something should change and that the program, started in the 60s, fails at both of its core missions, reducing destruction and protecting the taxpayer. It was created with the good intentions of A, providing flood insurance at appropriate prices that protect the taxpayer, and B, reduce unnecessary flood damage. Well, NFIP has lost over $50 billion that it now owes the U.S. Treasury taxpayer. Any insurance commissioner in this country, all 50 states, would shut this program down for violating all of its rules by quite a bit. And regarding the other thing, reducing damage from floods, NFIP has been widely criticized by environmental groups like the Sierra Club for subsidizing continual unsafe building in flood-prone areas, thereby increasing the loss of life and property damage. Such is the history of well-intentioned government efforts involving weather-related risks, and for that matter, other risks like mortgage subsidies. Three, potential harm to credit union members. So the only reason to put the RFI out is because there's some chance that someday NCUA may take some action. That future action could manifest itself in rulemakings, guidance, examiner trading, data collections like our call reports, or other documents that signal NCUA's priorities and approach. That could be our strategic plan, our supervisory priorities, our pre-exam questionnaires for credit unions, call reports. All of these things communicate NCUA priorities and can influence behavior. Thus, any change in any of those communications can have the potential to nudge credit unions towards or away from certain behaviors that may not be in their members' best interests. Example, let's say there's a local oil refinery expands. You mentioned the one in your town closed years ago, right?
It's now still open, still the 6th largest in the country.
Oh, it is? All right, but, all right, I thought, did it reduce employment? Does it have to say much or no?
Employment.
Either way,
Not at all.
industries, even growing ones, have failures, right? Especially when you're in the growth stage, like tons of solar companies go out of business because that's what happens when there's a new industry. A lot of people enter it and some work. But let's say the local oil refinery expands and the local credit union has the opportunity to expand membership and lending activity that is indirectly related to the oil and gas business. So this is a good news scenario. The bad news would be shuts down and, the town's in trouble. This is the good news scenario. They're increasing employment. You can foresee a scenario where NCUA's words might give that credit union pause about increased exposure, even indirectly, to the fossil fuel industry. We talk about diversifying field of membership so you're not as dependent. This would be the other way around. You come back for your exam the next year and have more exposure to oil and gas, indirectly. That NCUA-caused reticence could result in harm to those potential new members and to the credit union's finances. Again, it's hypothetical, but I'm just elucidating my apprehension about what might happen in the future. Also, like auto loans, today's RFI mentions the risks related to shift from gasoline-powered vehicles to electric and hybrids. Sure. I worry we might, in theory, ask credit unions for data on the share of their auto lending that's for electric and hybrids. Someone out there might feel this is a nudge, indicating a shift towards those type of vehicles, hybrids and electric, is the better answer, the easier answer, the one that makes your exam go a little quicker. We all know questions where someone's just asking questions, but there's right answers and wrong answers. People want to get the examiner's head nodding, and they get an impression. Meanwhile, these credit unions live and breathe the auto lending market. It's 35% of all 2 trillion assets in the whole credit union system. This could result, our efforts, our wording, what we ask for, what we don't ask for, could result in tweaks to loan pricing that make some vehicles more desirable than others. That sort of nudge would interfere with the credit union's ability to price risk in the markets they know best, and perhaps give a credit union member a less favorable deal than they otherwise might have gotten. And fourth and lastly, all these important issues we're talking about have existing work streams. They deal with climate-related disasters all the time. Farmers have bad crops. There's flooding. And NCUA involvement could dull the market signals that make those work streams fund well. Credit unions are already watching land prices in flood-prone areas. They're watching the constantly shifting insurance markets for homes and vehicles. And NCUA already has sensible concentration limits and other regulations. And of course, there's a lot of entities out there who write checks before NCUA's deposit insurance kicks in. We don't insure homes in flood-prone area. We don't insure vehicles. We insure the deposits. And obviously there's a connection there, which is why we're talking about this. But there's a lot of, Fannie Mae, Freddie Mac, crop insurance, homeowners insurance, property casualties, a lot of people writing checks who are focused on these things. So there's a potential here to view climate as a separate work stream or an area of regulatory focus that could interfere with the existing process. Some public officials have explicitly said that they would like to have a separate part of the exam that's just on climate, even though I think all of those things, while changing, are embedded in other things. Some people, we have camels, 6 letters. Some people want to be camels, climate to be one of them. I'm not saying I'm an industry has that view, but I've heard it. So a couple of questions. Early when I made that statement, we in DC don't need to tell people, for example, in Puerto Rico that they get hurricanes. And that situation where there's a decision on a loan to somebody who'd been affected by severe weather events, the credit union people in the room have lost their own homes, and the room they're in is in a building that was also rendered uninhabitable by the same disaster. Thinking about the people in that room making a decision, may I ask whoever would like to grab it, who is best able to manage these local risks? The people in that room or the people in this room?
I'll take that question. So first, I'd like to acknowledge the hardships experienced by the people of Puerto Rico as a result of the recent
And we could have
hurricanes.
picked many other places that have had disastrous
Right.
issues, yeah.
So to answer your question, yes, Puerto Rican credit unions know their community and their members better than we do here in Washington, D.C., and they understand responding to hurricanes better than most of us in D.C. However, we would be hopeful that should the RFI be approved, that they would respond and share their knowledge with us and experience with NCUA. So that concludes my response.
If you had to give an answer, would it be the people in that room or the people in this room that are more in tune to managing the risk?
Well, I think managing the risk of hurricanes would be the people in that room.
And the financial risks associated with the hurricane?
Yes.
They're lending their own members money, not ours.
Right. But I would hope that they would share their knowledge with us.
Sure.
I mean, that's the goal of the
I was trying to get
RFI.
at,
Mhm.
nobody's going to get this perfectly.
No.
But the people closest to it, lending their own money, living and breathing the local market, land prices, insurance prices, et cetera, versus us from afar here. I'm just trying to think, if you had, nobody's going to get it right perfectly. But which group of people is more in tune with the financial risks associated with their local natural disasters?
The people in,
And, yeah, people closest to it. And it could be flooding in Iowa, it kills the corn crop and all that. Okay. And last question. The RFI mentions one of the purposes of it is to deal with changes in government policies that might harm financially vulnerable households and communities. What are examples of changes in government policies that might harm those vulnerable folks?
So thank you for that question. That's a really good question. So suppose the government offered incentives like low interest bonds to support upgrading municipal energy grids to low carbon alternatives. So there would be a set of municipalities with a sufficient tax base to be able to take advantage of those incentives, but disadvantaged communities might not have the tax revenues available to do so. So in this case, these financially vulnerable communities would remain reliant on less efficient energy sources. This would depress property values vis-a-vis those communities that were able to take advantage and upgrade. And because they haven't, these financially vulnerable communities have not transitioned, they remain reliant on traditional fossil fuel energy sources. They would also remain vulnerable to swings in fossil fuel prices. And as you know, rising fuel prices reduce discretionary income. So financially vulnerable communities and households that haven't been able to take advantage of this program would see lower property values, reduced discretionary income, and these things have direct bearing on household wealth, potentially on a household's ability to obtain credit and banking services, and these things also have implications for a community's tax revenue stream. So ultimately, this policy could leave financially vulnerable households and communities worse off and exacerbate existing inequities.
Gotcha. You mentioned they'd be vulnerable to changes in the price of oil and gas.
Right, because they're still reliant on the oil and gas.
Yeah. Would they be vulnerable to changes in the price of other kinds of power?
To the extent that they're using other kinds of power, but I mean, if your home is being powered by fossil fuel generated energy, you're paying for that energy. If you have solar panels on your roof, you're paying, I mean, I don't have them unfortunately, but you're paying next to nothing. So you're more susceptible to swings in energy prices and to higher energy prices. And we know that energy prices are very volatile. So that's a negative.
Understood. Back to Chairman Harper.
Thank you so much, Vice Chairman Hoffman. I've been down to Puerto Rico where I've seen a cooperativa, which is the credit unions of Puerto Rico that are chartered by the government, are called cooperativas, that has built a whole resiliency center after the storms, and literally they have a community kitchen attached. They actually set aside oil and gas so that they need it, and clean water well that will operate regardless of what the environment is. That is an example of something that we're hoping to get more information out, not to require others to do it necessarily, but to get an understanding of where things are.
And if I may, it was brought to my attention in a meeting with the credit union, this is why I like to meet with these folks, they know a lot of things I don't, that in the Inflation Reduction Act, there was a big pot of money, I don't know, 30 billion, something like that, for the EPA fund.
Greenhouse gas, yeah.
And credit unions, you know, regardless of whether you think you agree with the politics, if there's money out there, you might as well try to get your piece of it, right? And some of it would be lending to things like we talked about, EV stations, but the one that hadn't occurred to me was credit unions getting grants from that bucket of money to retrofit their own physical location.
Yeah.
And that, you know, that was off my radar, so I thought that was interesting. But again, when I looked at Katrina in 2005, that hurricane, when I looked up why we lost credit unions, part of it was the flooding, and they had the record. So even when the power came back on, it was very hard to restart their business when everything was gone. But anyway, yeah, back to you, Chairman.
No, thank you so much. Board Member Hood.
Great. Thank you, Mr. Chairman. And thank you all, Lisa, Rachel, and Marvin, for joining us this morning. I must say that I certainly believe that climate change is, in fact, an important issue. But as of now, my view is that credit unions know best how to manage and mitigate the risk in their respective communities, and not, quite frankly, the NCUA. It is, however, worth noting that the RFI before us today does not change any NCUA policy or supervision for climate change. Changing policy will require future board action, as the chairman just enunciated. However, nothing I will say today should constrain me or, quite frankly, lock me into a position one way or another for future action regarding climate change. I'm indeed open to studying this issue more and would like to see the best public policy option prevail. When it comes to future specific action, however, I'd like to see this board adjust the loan maturities for solar loans to 25 years. Current regulations make it hard for credit unions to compete in this dynamic market because of our existing regulations that limit the maturity for solar loans to 15 years. That's just one example. As many of you may know, I am from North Carolina, where I grew up and still like calling it home. It's also where I began my professional career almost 3 decades ago, working in commercial lending and community reinvestment, urban renewal, and all those types of things we called it then. A lot of that work focused on affordable housing, small business, substantial outreach to marginalized, low to moderate income communities. I don't think anyone called it stakeholder capitalism back then, but it's essentially what we were focused on then. We were focused on sustainability and impact, issues that are at the center of our discussion today on RFI, on climate. So you could say that I've been intensely involved in one way or another in the world of stakeholder capitalism from the start of my career. From that standpoint, I've watched as these ideas have spread more widely within the larger business world. I continue to be a strong supporter of the key tenets of stakeholder capitalism, including diversity, equity, and inclusion initiatives, and ESG goals. And I continue to make the case for these practices because I believe they're the right thing to do, and I believe they're good for business and society. But in my position as a financial services industry regulator, I prefer the go slow approach, and I've sought to encourage these practices without being heavy-handed about it. For instance, when it comes to ESG regulations for credit unions, including climate change, I'm cautious about stepping in with regulatory solutions, and I'm certainly not comfortable with the suggestions that regulations should be forcing a commitment to the ESG framework at this particular moment in time. So I am delighted that those at the board table today have mentioned, Mr. Chairman, that this is not going to result in any rulemaking without a policy by this board. One, though, could even argue that ESG regulation is not urgent at this stage for the system of federally insured credit unions that we currently oversee. We're talking here about smaller, nonprofit, membership-driven financial institutions with a strong mission orientation. As such, their ESG impact simply doesn't compare to publicly traded firms with national or international scale. And I'd even go a step further. When I talked about having been a Community Reinvestment Act officer in my early days at a Wall Street company, those institutions, I don't want to pick on the banks, but they literally have to do a lot of the good deeds that they're doing because of government fiat. Credit unions are doing a number of things around people helping people. It's in their orthodoxy, it's in their philosophy to do things, whether it be community development, or in my case, when I'm talking today about the things that credit unions are already doing around sustainability. For example, last year, the NCUA approved a charter to establish a new credit union in Lame Deer, Montana, that will provide financial services to a largely Native American population. A credit union in Lame Deer, Montana is not going to have the same concerns as a systemically important global financial institution. So the regulatory needs are going to vary by industry to industry. It's also why I don't get overly exercised about the criticisms of ESG and stakeholder capitalism. The reality is that if these concepts are going to be effective and win wider acceptance, then they must be subjected to critical evaluation and testing. I recently spoke at an event that highlighted the promise and peril of stakeholder capitalism. That gets it exactly right. We need to be looking at these frameworks carefully to assess both their strengths and weaknesses, assessing them on their results and not just on their stated good intentions. I do have a few questions, and one is, you mentioned that there were similar RFIs released by other financial regulatory agencies. Could you maybe expound upon what have those agencies done as a result of the responses they received to the RFIs, and have they issued any new guidance or regulations?
I'll handle that one. So the three major banking agencies, the OCC, the Fed, and the FDIC, are working on proposed guidance on this issue, but those are specifically targeted to huge banks with over $100 billion of consolidated assets. So that's the most tangible result of what they've been doing, and the OCC issued theirs in December of 2022. The Fed issued theirs in November, and FDI just did last month. So the FDIC's comment period is open currently. The other two, the comment periods have closed. Now they're analyzing their public comments. CFTC issued a request for comments last June, but they haven't gone further. And the FHFA were the first to issue requests for comments. That was back in January 2021, but they haven't done anything further on that. Their request for information.
Very well, thank you. But in the summary that you just gave, that one institution was for banks, 100 billion and over.
Right,
And
yeah.
for us, we only have one institution that I recall that would even meet that threshold if we were to do apples to apples. Another question, I would just maybe just, and this is more for the industry, just making sure that they are aware, as the vice chairman alluded to, the EPA and the Greenhouse Gas Reduction Fund. I think it is important for credit unions to make use of those resources as they seek opportunities to reduce their emissions. So I'm hoping that they will make that available. I know I met during the recent government affairs conference with folks from Inclusive who were telling us about the advantages of that. So I do hope that when there are opportunities for credit unions to use these types of tools, that they are making those tools, making use of those tools. Another thing, and Rachel, this is maybe to you. I know that you are on the task force and you all just released some research on yesterday, which I thought was very timely as we all were preparing for today. Any highlights from the research that you'd like to share?
I think Chairman Harper did a wonderful job sharing all of the highlights. So at risk of being redundant, I refrain. But I mean, I do think the key takeaway from that is that there is a substantial share of credit unions, 25%, that are located in communities based on FEMA's definitions that are very vulnerable to extreme weather and natural disaster events. And so it does illustrate that this is an area of concern. And if I may just say that I appreciate your comment about going slow, and that is one of the reasons why we're doing this. We don't want to rush headlong into anything, I think, and we really want to study the issue and understand better what credit unions are doing and how they're thinking about it. And I think research we did sort of underscores the need for that.
I think so. Well, great. Well, thank you. And I must say, I could have used all of the rationale that the vice chairman just enunciated regarding why he will not be supporting today's rule. But I, Mr. Chairman, as you may recall, I gave you my word almost a year ago that I would be supporting today's rule because it is a priority that has been quite important for you for quite some time. And I wanted to give my support. So while I could easily have used his rationale, I shan't at the board table because of my word, and my word is my integrity, and I cannot turn it on and off like a faucet. So I will, in fact, be supporting this because of the commitment that I made to you. And I hope you recognize that I also am very excited about one of my priorities, and that is you all as Part 701, 714, Financial Innovation, the loan participation, eligible obligations, and notes of liquidating credit unions. I would certainly hope that we can bring that matter to the board. My office is having ongoing conversations with your office regarding this matter, and where there may be a bit of a reluctance and recalcitrance around giving a definitive date, I remain hopeful, Mr. Chairman, that I can work with you and the vice chairman to bring that rule to fruition, just as we've done today with today's climate RFI. That concludes my remarks, and thank you all.
Thank you. And I very much appreciate and understand the gentleman's concern and the priority that he has placed on the loan participation rule. I can tell you that staff is working diligently and quickly, and I've asked them to work as quickly as possible, but making sure that we cover all the points that are needed. Certainly, we could see that no later than September, but if it were ready earlier for July, I would certainly be open to bringing it in July. I know you want to make sure that this gets across the finish line sooner rather than later.
Yes, Mr. Chairman.
Great, thank you so much. And just one other thing, if I could, on economics. When I was taking my graduate school level economic classes, there were 6 things you needed for perfect competition. Many buyers, many sellers, low barriers to entry, low barriers to exit, homogeneous product, and perfect information. I'm viewing today's discussion and this RFI as ability for us to get to perfect information. Will we ever get to the perfect information? I don't think so, but I also understand that boots on the ground, those who are most local to concerns, often have the best way of dealing with and understanding them.
Appreciate that, and respect for your graduate study in economics. What scared me a little bit, and again, I'm kind of with Rodney. I don't think this is the end of the world,
Yeah.
but I'm going to vote no because of my apprehensions. But what scared me is us discussing, changes in the market, and, this kind of power is good. And this is all interesting, but this isn't for us to have, right? My next car is probably going to be, well, it's definitely going to be a hybrid or Electra. I've driven a Tesla. They're great. If I could afford one, I'd get one. But was it a year ago and last winter when I think it was 95, there was a huge snowstorm and people stayed overnight in their cars in Virginia?
Yeah, last time.
Senator Tim Kaine.
Yeah.
Spent the
No,
night
it
in
was
his
a year ago,
vehicle,
yep.
was there for 27 hours, you know, and this is why the discussion should be car buyers and car sellers and car lenders, not us. But if you remember when, after 27 hours of being stuck there, you know, freezing in their cars, when it finally cleared up, you could tell who had electric cars because they ran out of power,
Yep.
just like your phone did, and all the other cars went. And Tesla has roadside assistance. They have these trucks that come help you. Tesla's roadside assistance is only gas-powered vehicles. So anyway, I don't know, again, if I could afford a Tesla, I'd buy one today. I think they're very cool, but these back and forth are not discussions for us to be having, you know, the marketplace out there. We don't need to go to a fourth generation corn farmer and say, do you know a flood will hurt your corn crop? You know, that's my view. Go ahead.
Understood, understood. So, thank you, everyone, for that robust debate. Is there a motion? I move that the board approve a request for information and comment on climate-related financial risk for a 60-day comment period as attached to the board action memorandum. Is there a second to the motion?
Second.
There is a sufficient second. All those in favor say aye.
Aye.
All those opposed say nay.
Nay.
Let the ayes have it, and let the record show that the motion passes 2-1. And thank you, everybody, for your really good work on this. And I'm especially looking forward to seeing the types of comments that we get back. I think that they,
I'm interested as well,
Yeah.
seeing them.
yeah, so, thank you.
Thank you.
Now let's turn to our third and final item of business on today's agenda, a requested board briefing on the Federal Credit Union interest rate ceiling. Staff presenting are Amanda Parkhill, Deputy Director, Office of Examination and Insurance, Nagi Khalid, Director, Credit Markets Division, Office of Examination Insurance, and Justin Anderson, Senior Staff Attorney, Office of General Counsel. Amanda, Nagi, Justin, please begin whenever you are ready.
Thank you. Good morning, Chairman Harper, Vice Chairman Hopman, Board Member Hood. We're here today to follow up, to conduct a follow-up briefing with the board on the Federal Credit Union loan interest rate ceiling. At the January board meeting, the board voted to continue the temporary 18% interest rate ceiling for loans made by federal credit unions based on the authority established by the Federal Credit Union Act. In January, the board committed to conduct further research on the impact on the safety and soundness of individual federal credit unions in accordance with the requirements of the Act. The board also requested that the Office of General Counsel assess whether a floating interest rate ceiling is legally permissible. Next slide, please. Today, the Office of General Counsel will share the results of their assessment. Additionally, we will share background on the history of the loan interest rate ceiling, discuss trends in unsecured lending portfolios in federal credit unions, share an economic outlook related to market rates, and discuss the safety and soundness impact of the interest rate ceiling on individual federal credit unions. Next slide, please. I'll now turn it over to Justin to discuss the floating interest rate ceiling.
Thank you, Amanda. Good morning, all. Per the board's request, the Office of General Counsel undertook a comprehensive review of all primary and secondary sources as they relate to the board's legal authority to set a floating interest rate ceiling under the Federal Credit Union Act. During our review, we looked at the plain language of the Act, the legislative history surrounding the interest rate ceiling provision in the Act, applicable case law, what other federal agencies have done with setting interest rate ceilings, and commonly accepted meanings of the term interest rate ceiling. Upon completion of our research, it is the Office of General Counsel's opinion that it is reasonable to interpret the Federal Credit Union Act to permit a floating interest rate ceiling, provided the conditions in the Act are met. I will now turn it over to Nagi to discuss E&I's analysis. Thank you.
Thank you, Justin. And good morning, Chairman Harper,
Good morning.
Vice Chairman Hoppman, and Board Member Hood. Next slide, please. Next slide, please.
There we go.
The Federal Credit Union Act generally limits federal credit unions to a 15% interest rate ceiling on loans. The board, however, has the discretion to increase the loan interest rate ceiling for periods not to exceed 18 months if the following criteria are met. One is that a determination that money market interest rates have risen over the preceding 6 months, and two, a determination that prevailing interest rate levels threaten safety and soundness of individual credit unions, as evidenced by adverse trends in growth, liquidity, capital, and earnings. And we will focus our discussion on the second criteria for the remainder of the briefing. Next slide, please. To provide a quick background, in December 1980, the board raised the interest rate ceiling to 21% when the Fed funds rate was at a range of 19 to 20%, which was its highest ever, and combined with an inflation rate of about 15.5%. Subsequently, the board lowered the ceiling to 18% in May 1987 after rates began drifting downwards to below 10%. The temporary 18% interest rate ceiling has since remained in place and was extended at the January 2023 board meeting through September 10th, 2024. Next slide, please. We will now discuss historical trends in the unsecured lending portfolio within the federal credit union industry. Next slide, please. The federal credit union's unsecured lending portfolio consists of credit cards, private student loans, payday alternative loans, otherwise known as PALs, and all other unsecured loans. During the past 11 years, since we started collecting information on each of these components, federal credit union's unsecured lending has expanded, with the unsecured loan balances more than doubled from $40.7 billion at the year-end 2011. The $26 billion increase in credit cards and $21 billion growth in all other unsecured loans contributed to 90% of the $51.6 billion expansion. As of year-end 2022, the $92 billion unsecured loan balance accounted for 12% of federal credit union's total loans and lease balances. Although private student loans and PALs represent a small portion of total unsecured loan balances compared to credit cards and other unsecured loans, these two categories have recorded the fastest growth during that same time period. Notably, the PALS program reported a $105 million outstanding balance at year-end 2022, an increase of $31 million from the prior year. However, given the short-term nature of the PALS program, the growth in PALS was even larger when considering the total 227 million PALS granted year-to-date compared to the 167 million PALS granted in 2021. Additionally, the $3.2 billion growth in the fourth quarter of 2022 in credit card portfolio registered close to half of its $7 billion expansion during 2022. Next slide, please. Furthermore, as of December 31st, 2022, nearly 75% of federal credit unions reported having unsecured loans with interest rates greater than 15%, totaling $28.8 billion with a weighted average loan rate of 17.23%. Additionally, close to 75% of federal credit unions with loan interest rates greater than 15% have either low-income or minority deposit institution designations or are certified as community development financial institutions, as shown on the right section of that table on the slide. The $4.8 billion total balance of loans with an interest rate over 15% in these federal credit unions make up 16.6% of total $28.8 billion in overall loans with interest rates over 15% amongst all federal credit unions. Additionally, 46% of these federal credit unions have assets less than $50 million. Next slide, please. Both share and asset growth slowed down during the first quarter of 2021. Slowed down after the first quarter 2021 spike with the ending of the various government-sponsored relief programs to counter the pandemic impact. And since March 2022, the Fed has started raising interest rates to fight the historically high inflation. As a result, both federal credit unions' share growth and asset growth continued sliding to below 6% from the high of over 20% back in Q1 2022. During the same time period, loan growth had maintained a rapid expansion, with growth rates exceeding the share and asset growth after the first quarter of 2022, reaching about 21% during the third quarter of 2022. Next slide, please. And despite the rapid increase in the Fed funds rate since March 2022, the cost of funds for federal credit unions was relatively stable during 2022, with just 17 basis point increases during the last 3 quarters of up to 55 basis points, which was still lower than 75 basis points at the year end of 2020. The return on average assets, which is the purple line on the slide, and net interest margin, which is the dark blue line, have been stable at around 0.9% and 2.8% respectively. Next slide, please. Before we address the safety and soundness analysis of the loan interest rate ceiling on the individual credit union, federal credit unions, We will first provide a quick overview of the current economic outlook. Next slide, please. With a 475 basis points increase between March 2022 and March 2023 by the Federal Reserve to battle high inflation, the Fed funds rate reached a range of 4.75 to 5%, which was the highest level it had reached since October of 2007. The latest policymaker forecast issued in May 2023 suggests that the Fed funds target rate will peak at 5.1% this year, and that rate cuts would follow in 2024 and 2025. Next slide, please. Next, we will address the impact of a 15% interest rate ceiling on individual federal credit union safety and soundness. Next slide, please. The safety and soundness impact of a loan interest rate ceiling at any rate below 18% will be borne by individual federal credit unions disproportionately. The reduction of interest income would adversely impact federal credit unions' liquidity, capitals, earning, and growth potential, especially for federal credit unions with negative earnings or lower liquidity ratios. We will zoom in on three segments of the federal credit unions population to address the potential safety and soundness impact of the loan interest rate ceiling were to revert back to the 15% statutory level. First, we will discuss federal credit unions with a concentration in loans with interest rates over 15% above 10% of total assets, followed by federal credit unions with loan interest rates above 15% with negative earnings, and finally, with federal credit unions with loan interest rates above 15% with lower liquidity positions separated by CAMELS ratings. Next slide, please. Based on the December 31st, 2022 call report cycle, 33 federal credit unions have concentrations of over 10% of total assets in loans with an interest rate greater than 15%. In addition, 25 of those 33 federal credit unions are smaller credit unions with assets less than $10 million. Secondly, and as of the last quarter of 2022, 299 federal credit unions with loans with interest rates above 15% reported negative earnings, with an average negative return on assets rate of 24 basis points. And about $200 million of federal credit union loans with greater than 15% interest rates are carried by these 299 federal credit unions at an average interest rate of 17.3%. And 246 out of the 299 federal credit unions are smaller credit unions with assets less than $50 million. The data shows if the loan interest rate ceiling were to revert to 15%, these 299 federal credit unions with an average size of $72 million would experience an average interest rate reduction of 230 basis points, or lost interest income of up to $4.6 million, which would result in a further negative impact to their earnings and consequently their net worth positions. Next slide, please. As of year-end 2022, 359 of the 2,167 federal credit unions with loans having over 15% interest rates were rated a CAMELS 3 or worse on the most recent examination. 37 of these federal credit unions had less than 6% short-term liquidity ratio, with $75 million in high-rate loan balances with an average loan rate of 17.3%. If the interest rate ceiling were to revert to 15%, the 230 basis point reduction in interest margins could lead up to $2 million loss in interest income. This might result in further deterioration of the short-term liquidity ratios for these federal credit unions in the event they continue their loan activity unchanged. Not only are the federal credit unions with low CAMELS ratings facing this liquidity challenge, but even federal credit unions with strong financial and operational conditions experienced a tightening in liquidity over the last 3 quarters of 2022. Among 1,808 federal credit unions with loans above 15% and a most recent CAMELS rating of 1 or 2, 247 of these institutions had an average short-term liquidity ratio of less than 6%. Furthermore, $3.2 billion, or 11% of the total $28.8 billion in loan balances with greater than 15% interest rates was concentrated in these 247 federal credit unions. If the loan interest rate ceiling were to revert to 15%, these federal credit unions would experience an aggregate interest cash flow reduction of up to $72.6 million from this segment of loans that currently have an average interest rate of 17.3%, which could potentially lower the average short-term liquidity ratio to even less than 4%, without a change in liquidity activity. Next slide, please. In summary, our additional analysis confirmed the previous assessment that reverting the loan interest rate ceiling to the statutory level of 15% as established in the Federal Credit Union Act will potentially threaten safety and soundness of individual federal credit unions. This concludes our briefing. Thank you for your time this morning. I would be happy to answer any questions you might have.
Thank you, Nagi. Thank you, Justin. Always good to have you both at the briefing table. And thank you, Amanda, for answering questions. As noted in today's presentation, the NCUA board in January authorized the loan interest rate for federal credit unions to go above the 15% ceiling by approving an 18% ceiling effective through September 10, 2024. The board further committed in January to monitor economic conditions to determine whether the standards set forth in the Federal Credit Union Act would require a change in the interest rate ceiling before September 2024. And the board also committed to evaluating the legal and policy issues related to a floating interest rate ceiling. As Nagi noted, NCUA staff analyzed recent market and financial conditions and concluded that money market rates have risen over the preceding 6 months. That fact comes as no surprise to any of us here, as we've certainly seen the Federal Open Markets Committee continue to raise rates, although it seems to be down on a more slower pace. Staff also concluded that lowering interest rates below 18% would threaten the safety and soundness of several individual credit unions. To change the interest rate ceiling for federal credit unions, we must consult with certain parties like Congress, the other federal banking agencies, and the Treasury Department. There is also a legal standard requiring us to determine that the prevailing interest rate levels threaten the safety and soundness of individual credit unions in several aspects. That brings me to my first question on slide 5, Justin. What is the legal standard that the NCUA must use to act on a maximum interest rate ceiling for federal credit unions?
Thank you, Chairman. In order to raise the interest rate ceiling above the statutory 15%, there are 4 separate conditions that the board must satisfy. As you've mentioned, they must first consult with the appropriate committees of Congress, Department of Treasury, and the other financial regulators, determining that money market rates have risen over the preceding 6 months, and that prevailing interest rates threaten the safety and soundness of individual credit unions as evidenced by adverse trends in liquidity, capital, earnings, and growth. And finally, any interest rate that the board sets above the 15% statutory ceiling cannot exceed 18 months in duration.
Okay. And Justin, focusing in on and it's the last sub-bullet on this page, the liquidity, capital, earnings, and growth. It's an and there, not an or.
Correct.
So that's a higher legal standard to meet overall.
Correct.
So we would have to see evidence of all of those things before we could act.
That's correct.
Okay. Thank you so much for that answer. It's helpful for credit union stakeholders to understand the requirements of the Federal Credit Union Act for raising the interest rate ceiling above 15% and the specific criteria that the board must make sure are satisfied before the ceiling can be raised. My next question is for either you, Amanda, or for Nagi. Some in the industry contend that the NCUA board should raise the maximum interest rate ceiling so credit unions can compete with community banks, specifically in the area of credit cards. As I noted in January, however, federal credit unions could instead offer members a classic credit card without rewards, which are often priced much lower rates than our rewards cards, as a way to serve their members while interest rates remain higher than usual. That leads me to my next question. Can credit cards include lower rates if rewards programs are structured differently or if no rewards are offered?
I'll take the question, Chairman. So credit card interest rates are typically based on several factors, including a member's creditworthiness, the overall risk being borne by the credit union, and the terms of the credit card agreement. However, another important factor to consider is the cost of operating a credit card program.
Sure.
And rewards programs specifically can often be expensive for credit unions to maintain and can add to their operating costs. Those costs are usually passed on to members through higher interest rates or through fees. Therefore, and to answer your question, if a credit union offers limited or no rewards programs on their credit cards, it may have the ability to reduce its operating costs of maintaining such credit card programs, and those savings could potentially be passed on to their members in the form of lower interest rates.
Great. Thank you for that response. It's clear that federal credit unions can alter their product offerings and remain competitive without an increase to the maximum interest rate ceiling. My next question is for Justin and Amanda. During meetings with the NCUA board members, industry trade groups and certain credit unions have stated that they want to see the ceiling raised to 21% or modified to become a floating ceiling. And I know, Justin, you spoke about the legal analysis. How would a floating interest rate ceiling impact the current NCUA policies and regulations? And what policy-related questions would we need to address before we considered such a change and move forward with it?
So I'll go first. There's several policy decisions that
Yeah.
would need to be made, starting with setting the rate.
Sure.
So the board would have to consider things like what index to use, an appropriate margin, the frequency of which the floating rate would adjust, just to name a few. Additionally, the board would need to consider the amount of time that credit unions might need to update their systems, policies, member disclosures. Similarly, for NCUA, we would need time to ensure that we had systems in place. So, for example, we'd need to make sure that we have a tool for our examiners to track what the maximum rate is at various points in time so that they can properly examine loan portfolios. I'll turn over to Justin to talk about regulatory changes.
Thank you, Amanda. In terms of regulatory amendments, if the board were to adopt a floating interest rate ceiling, the board may have to adjust the interest rate rule at 701, at 12 CFR 701.21, including potentially modifying the NCUA's payday alternative loan program rule. Thank you.
Would we have to potentially also adjust our loan rule too?
Yes, sir.
Okay, and you say payday alternatives, and and I would assume, Amanda, from a field perspective, examiners would have to be trained, and we'd have to develop systems that would allow them to quickly check on the date that this loan was made, where was the interest rate, because of course they are constantly changing. So there would be some administrative burden there too.
Absolutely.
Great. Thank you both for that answer. As you noted, a floating ceiling, should the board decide to make that change, would take time to implement and have implications across the agency's rules, regulations, exam procedures, as well as credit union operations. In January, I also maintained that an increased interest rate ceiling would place greater burdens on households with credit card debt and tip some family budgets into the red. Indeed, Inclusive CEO Kathy Mann shares my opinion when she recently wrote in Credit Union Times, quote, "It's hard to see how raising the cost of capital for people who are struggling financially actually helps. People with damaged credit are the very people and households already hardest hit by rising costs and volatility in employment. In our economy, these challenges are disproportionately borne by Black and Latino households. Typical Black and Latino household workers make 20% less than white workers, experience higher rates of unemployment, and have less or no generational wealth to fall back on to manage unexpected expenses or hard times. Moreover, the legacy of redlining has resulted in the cost of capital in Black and Latino communities being higher and access to responsible lending harder. As a result, credit scores for Black and Latino borrowers are disproportionately lower, and they will face higher loan rates if the interest rate ceiling is raised." So my final question for you all is this: whether it goes up or down, how does the maximum interest rate ceiling influence the rates federal credit unions charge their members? Are there other factors that influence interest rates that members are charged for financial products like personal loans, credit cards, and auto loans?
So I'll start. So there's a number of factors that would go into pricing. So the cap is just one aspect of it. It would be what market rates are, as well as what their costs are and the types of products they offered, and the stratification of their portfolio based on credit score or other factors they use for pricing.
And to add to it, as I mentioned before, the cost of operating the program itself is essential to determine what interest rates to charge. And as Amanda alluded to, the creditworthiness of the individuals play a huge factor into this. With what interest rate ceiling is set allows the credit unions the ability to determine how to risk-base their portfolio. And obviously that's a huge determination you would have to make depending on the quality of the applicants.
Yeah, and Nagi, am I wrong? My understanding is that some credit unions do risk-based pricing.
Right.
And some other credit unions really just do sort of a one-size-fits-all product. Is that correct out there?
Typically, smaller, less complex institutions could potentially, but most sophisticated credit unions do risk-based pricing. Yeah.
Okay, thank you. We must always remember who ultimately feels the effects of these interest rate ceiling decisions. The credit union system's statutory mission is to support the saving and credit needs of all Americans, especially people of modest means. With American households under increasing financial stress from inflationary pressures and economic uncertainty, we should not place additional and unnecessary burdens on these families. Thank you again, Nagi, Justin, and Amanda, for your hard work on this issue. That concludes my remarks. I now recognize the Vice Chairman.
Thank you, Mr. Chairman, and thanks to Amanda, Justin, Nagi for the presentation. Obviously, in January, we voted to keep the interest rate ceiling at 18%. Congress was clear that the board has the authority to raise the ceiling above the statutory limit of 15%. There is only one number in the current Credit Union Act, and it's 15%, 1-5, there are no others. They can only raise it above 15%, which you guys summarized already. They can only raise it above 15 if the safety and soundness of individual credit unions is impacted by the 4 factors Chairman Harper already mentioned, and it's not an or, it's all of them. We saw the data in January and today, and again today, that lowering it to 15 would have an impact on safety and soundness of several individual credit unions. There were more than a few stakeholders, including today and yesterday, asking the board to raise the rate above 18%. We did not have the evidence in January that met Congress's criteria. Congress sets the rules, like everybody else. You do what your boss says, you don't work. After further analysis by the staff, we still don't have the data to support raising it. So that's discussion of raising it. And then I want to thank the chairman and the Office of General Counsel for the analysis on legality of using a floating interest rate for our ceiling. The concept of floating interest rate makes economic sense to me. If I was in charge of everything, including the Congressional Act, I would have what trillions of dollars of loans are priced at in the world, adjustable rate. That they don't happen every day. If you know any Canadians, you know their mortgages reset once a year, and it averages out. You know, nobody wants to deal with daily or monthly changes. But at this time, I don't think there's a way we can actually do a floating rate ceiling that would satisfy stakeholders. It's one of those situations where a majority of people will agree that another method may be superior, but that same majority will not agree on exactly what that method is. The comparison I use is for decades in polling, most Americans say, you know, it would be good if America had a viable third party. You know what they don't agree on? What that third party would do, right? So, and I know that it would not work from my conversation in the last few months. Credit union members also need to benefit when rates drop. 2020, overnight Fed rate, 0%. The 10-year Treasury bond briefly had a yield of 0.1% for 10 years. Treasury bills went negative, meaning you invest $100, get 99 back, and you're happy with that. That's how the situation was then. And 30-year mortgages could be had for under 2.5%. Let's say that scenario persisted for years, like it has in Japan. Incidentally, I still have a mortgage in Japan from when I lived there. It's a place I rent out. I have a 25-year floating rate mortgage. It's 1.96%. That's the environment they're in, okay? So if we had that scenario, the Japan scenario, or 2020 here, and that kept going, right? That was the rate environment. Any floating rate used by NCUA would have to, logically, yield a max rate at or below the 15% decided by Congress. And I know that is not what was expected by everyone who was asking us to find a way to raise our interest rate ceiling. And they said, can you move to a floating rate? Okay. Let's say we had that scenario in 2020. Let's say we're in Japan. Would you be cool max rate on all products of 14%? Oh, no, we don't want that. This is why I'm glad we did the analysis. It's still worth it. We scratched an itch. And I don't think it is feasible, and I think even the people who advocated for it, I could not get, out of 100 people advocating for interest rate, I bet I could not get 60 of them to agree on exactly what that would look like. And even those 60 might turn around and argue when rates were much lower. So that concludes my remarks, and I have no questions.
You have no questions. I thought you said that.
No, I have none. I have none.
Okay, thank you so much. Vice Chairman Haltman, Board Member Hood.
Great, thank you, Mr. Chairman, and now I can say good afternoon to our panelists. Almost. So good afternoon, Justin, Nugget, Amanda. Thank you all for joining us today. In January of this year, the NCUA Board considered whether the renewal of a temporary maximum loan rate of 18%, I mind you, a rate that has been sustained continuously by the NCUA Board action since 1987, should that in fact be extended once again. Indeed, the board voted to extend the 18% ceiling until September 2024. However, in our January meeting, we asked the General Counsel to opine if a variable rate is legal. At that time, the chairman said, and I can't have AI or ChatGPT use your voice, I'm just going to use the actual quote, and that is, if a floating interest rate is legal, we will need to move expeditiously with next steps, end of quote. In today's briefing, we learned that a variable rate is indeed a reasonable legal interpretation of the Act. After we discussed this matter at our January meeting, we received additional documents from the National Archives that showed that our General Counsel opined in the 1980s that a variable rate was a reasonable legal interpretation, but at that time, staff recommended, and I quote, the board not use the floating or index interest ceiling rate, end of quote. And you all, I presume, from the operational considerations of implementing a floating ceiling in the 1980s. While we can all agree data processing has improved significantly since the 1980s, which would in fact make a variable rate easier to implement, I, however, remain concerned that a variable rate could be complicated for our smaller credit unions to implement and may cause operational problems with the Truth in Lending Act, among other consumer protection laws. As I called for in January, I still do believe that a 21% interest rate ceiling is appropriate and strikes the right balance to consider the statutory goals of thrift promotion and credit availability while being responsive to the economic conditions to avoid safety and soundness considerations. I do have a few quick questions. We have some instances where our federally chartered institutions are at a competitive disadvantage relative to state chartered institutions for loan interest rate ceilings. Of course, you all, I'm not advocating for high interest rates. We all know I believe in the importance of financial inclusion, but I am a believer in risk-based pricing. Can you discuss some of the advantages and disadvantages as it relates to the ability to serve underserved marginalized communities in regard to these interest rate ceilings?
I'll take the question, Board Member Hood. So as with any limitation or ceiling, there are advantages and disadvantages. It is possible that federally insured state chartered credit unions that operate in states with higher loan interest rate limits could have additional flexibilities to risk price their loan portfolios, which could potentially allow these institutions greater flexibility to serve underserved communities. However, in markets where there is a high rate cap or no cap at all, it is possible that certain borrowers could be charged a higher rate than they would be charged in a market that does have a cap.
Very well, thank you, Nagy. And I do have another question, that will be my final one. If the board somewhat adopted a variable interest rate, how would that impact the PALS program?
Board Member Hood, I'll answer that question. The Payday Alternative Loan Program, as it currently is written, would float in tandem with a floating interest rate ceiling at a level of 1,000 basis points above that ceiling. However, the Payday Alternative Loan Program could cease to exist if the floating rate did revert back to 15%.
Got it.
Thank you.
Great, thank you, Justin, and thank you all for your presentation. And I do want to thank the General Counsel's Office for the alacrity in which they were able to do the research, for you all in your analysis and giving us all the data points today. Thank you, great discussion. That concludes my comments.
Thank you so much. And if I could ask all three of you to continue to keep us informed. Certainly, as I understand it, there are the four elements that have to be met, but we don't quite have to wait until the credit unions are in trouble. If the trends are going in a certain direction, we should take a look at that. And I ask, certainly in this uncertain interest rate environment, let's stay abreast of that. Thank you, everyone, and thank you all who are here today. That is the end of our meeting and of our open board meeting. There being no further business, we are hereby adjourned.